Good morning and welcome back to our weekly market update. Today is Monday, August 10, 2026. Let's jump right in. Looking at the markets, US equities posted strong gains last week, with the S&P 500 and Dow reaching record highs, while the Nasdaq finished near its previous peak. The Nasdaq, however, led the weekly gains, rising 5.2%, followed by the S&P 500 at 3.6% and the Dow at 3%. Market did experience some midweek volatility as investors reacted to missed corporate earnings and renewed uncertainty around the oil prices. However, sentiment improved later in the week, supported by stronger earnings released late Thursday and a weaker employment report on Friday. The weaker employment report also contributed to a pullback in Treasury yields later in the week. The 10-year Treasury yield ended the week at about 4.65%, roughly 10 basis points below the prior week. The decline in yields eased concerns around further Fed tightening and provided additional support for equities, particularly growth-oriented areas of the market. Turning to the economy, July's ISM reports shows that activity remained relatively strong. Manufacturing PMI increased to 55.6, while services PMI rose up to 54.1, and with both readings remaining above 50 and therefore indicating expansion. Underneath the headline numbers, however, the picture was more mixed. Manufacturing employment improved, while services employment moved into contraction. Price pressures also remain elevated, particularly in services. So the main takeaway is that economic activity remains resilient, but employment and inflation trends continue to send mixed signals. We also received encouraging labor productivity data last week. Non-farm business productivity increased 2.2% from a year ago, as output grew 2.5%, while hours worked increased only slightly at 0.2%. At the same time, unit labor costs rose relatively modest 1.4%. This combination of stronger productivity and moderate labor cost growth is quite encouraging, with productivity growth outpacing the increase in unit labor costs. Corporate earnings also remain a major source of support for the market, with 88% of S&P 500 companies having reported, 86% have exceeded earnings estimates, and 76% have beaten revenue expectations. Blended earnings growth has now reached 50.4% year over year, well above the estimate of 23.1% at the end of the quarter. Overall, the earnings season continues to point to strong corporate fundamentals, with stronger late-week results helping support Friday's market gains. Finally, Friday's employment report provided clearer evidence that labor market is cooling. Non-farm payrolls declined by 23,000 in July, while job gains for May and June was also revised lower. In addition, the unemployment rate edged down to 4.1%, but labor force participation also fell to 61.4%, suggesting some of that improvement reflected fewer people participating in the labor market. The weaker employment picture has pushed Treasury yields lower and reduced expectations for additional Federal Reserve tightening. Overall, last week U.S. equity posted another strong week, supported by resilient economic data, strong corporate earnings, despite periods of volatility amid continued uncertainty surrounding the Straits of Hormuz. That concludes this week's market update. Thank you for tuning in, and we look forward to seeing you again next week.
The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.